Hey everyone, and welcome back to the channel. Have you ever wondered if it's possible to become a millionaire? What if I told you that you could reach that seven-figure goal by investing just $500 a month? It might sound like a dream, but today I am going to break down the exact steps and show you how it is not only possible, but achievable for many of you watching right now. This isn't about getting rich quick. It's about getting rich smart. So, grab a notepad and let's dive into the blueprint for building your first million. The secret sauce to this entire strategy is a powerful force that Albert Einstein supposedly called the eighth wonder of the world: compound interest. Put simply, it's interest on your interest. When you invest, your money earns a return. The next year, you earn a return on your original investment plus the return you just earned. It creates a snowball effect that, over time, can turn a relatively small monthly contribution into a massive fortune. Let's imagine you invest your money and it grows by 10% in a year. If you started with $1,000, you'd have $1,100. The next year, that 10% growth applies to the full $1,100, not just your original $1,000. Your money starts working for you, and its earnings start earning their own money. This is the engine that will drive you to your $1 million goal. So, where do you put this $500 a month to make it grow? You're not going to get there by letting it sit in a savings account. The key is investing. For most people, especially beginners, one of the best and most recommended strategies is investing in low-cost index funds. What are those? An index fund is a type of mutual fund or exchange-traded fund, or ETF, that aims to track the performance of a market index, like the S&P 500. The S&P 500 is basically a collection of the 500 largest publicly traded companies in the United States. When you buy a share of an S&P 500 index fund, you're essentially buying a tiny piece of all those 500 companies. This gives you instant diversification, which means you're not putting all your eggs in one basket. Instead of trying to pick individual winning stocks, which is incredibly difficult even for professionals, you're betting on the overall growth of the market. Now let's talk numbers. The historical average annual return of the S&P 500, including dividends, has been around 10% over the long term. Of course, this is not guaranteed. Some years it's higher, some years it's lower, and some years it's even negative. But over decades, that 10% average has been remarkably consistent. So, for our calculations, let's use a slightly more conservative average return of 9% to be safe. If you invest $500 every single month and you earn an average annual return of 9%, how long would it take to reach $1 million? The math is staggering. It would take you about 35 years. That's it. By consistently putting aside that $500, you could build a $1 million nest egg. Let's break that down further. After 10 years of investing $500 a month, you would have contributed $60,000. With a 9% average return, your portfolio could be worth around $96,000. After 20 years, you've put in $120,000. But your investment could be worth over $330,000. Notice how the growth starts accelerating? That's the magic of compounding. In the first 10 years, you gained about $36,000 from the market. But in the next 10 years, you gained over $200,000. The snowball is getting bigger and rolling faster. By year 30, you've contributed $180,000, and your portfolio could be worth nearly $820,000. Just 5 more years of that consistent investing, and you cross the $1 million mark. This brings us to the most critical factor in this entire plan: time. The earlier you start, the easier it is. Let's look at two people, Alex and Ben. Alex starts investing $500 a month at age 25. By age 60, after 35 years, Alex becomes a millionaire. Ben, on the other hand, waits until he's 35 to start. He invests the same $500 a month. By the time Ben is 60, He's been investing for 25 years. How much does he have? Around $500,000. That's half of what Alex has, even though Alex only started 10 years earlier. For Ben to catch up and also reach $1 million by age 60, he would need to invest over $1,000 a month. That 10-year delay literally cost him $500,000. So if you're young, you have the most valuable asset of all, time. Don't waste it. Start today, even if it's not $500. Start with what you can. The second key ingredient is consistency. You have to make investing a non-negotiable part of your monthly budget, just like rent or your phone bill. The best way to do this is to automate it. Set up an automatic transfer from your bank account to your brokerage account every single month, right after you get paid. This is a strategy called dollar cost averaging. You're buying a set dollar amount of an investment on a regular schedule, regardless of the price. When the market is down, your $500 buys more shares. When the market is up, it buys fewer shares. This approach takes the emotion out of investing. You won't be tempted to panic sell when the market drops or get greedy when it says soaring. You just stick to the plan, month after month, year after year. This discipline is what separates successful long-term investors from everyone else. So, how do you actually do this? Here's a simple, practical guide. Step 1. Open a brokerage account. There are many great, low-cost online brokers like Vanguard, Fidelity, or Charles Schwab. You can open an account in just a few minutes. Step 2. Choose the right type of account. A Roth IRA is a fantastic place to start. It's a retirement account where your money grows tax-free, and your withdrawals in retirement are also tax-free. There are contribution limits, but for many people, it's the best tool available. If you max out your Roth IRA and still have more to invest, you can use a regular taxable brokerage account. Step 3. Set up that automatic transfer. Decide on your amount, whether it's $500 or $100, and make it happen automatically every month. Step 4. Choose your investment. Look for a low-cost, broad market index fund. Great examples are funds that track the S&P 500, like VU or FXAIX, or a total stock market index fund like VTI. These funds typically have very low expense ratios, meaning more of your money stays invested and working for you. Now, I know what some of you might be thinking. What about market crashes? What if I invest right before a big downturn? This is a valid concern, and it's why a long-term mindset is crucial. The stock market is volatile in the short term. It goes up and it goes down. There will be recessions and market corrections. But history has shown us that over the long run, the market has always recovered and continued its upward trend. If you're dollar cost averaging, a market downturn is actually a good thing for you. It means you're buying shares on sale. Remember, you're not trying to time the market. You're focused on time in the market. As long as you don't panic and sell, and you continue your consistent monthly investments, these downturns are just temporary bumps on your long road to $1 million. Finding that $500 a month might seem challenging, but it's often more about priorities than income. It's time to create a budget and see where your money is really going. Track your spending for a month. How much are you spending on subscriptions you don't use? Daily fancy coffees, eating out, or impulse purchases? That daily $5 coffee is $150 a month right there. Lunch out every workday can easily be another $300. By making conscious choices and cutting back on a few non-essential expenses, many people can find that $500. It's about deciding that your future financial freedom is more important than a little bit of instant gratification today. You can also look for ways to increase your income, like asking for a raise, developing new skills, or starting a small side hustle. Every extra dollar you can invest is rocket fuel for your journey to becoming a millionaire. So there you have it, the path to becoming a millionaire, isn't a complex secret reserved for the wealthy. It's a simple, clear formula. Invest a consistent amount of money, like $500 a month, into low-cost index funds. Automate the process and give it enough time for the power of compound interest to work its magic. The most important step is the first one, getting started. It doesn't matter if you start with $50 a month. The key is to build the habit. As your income grows, you can increase your contributions. Don't be discouraged by the long timeline. Time will pass anyway. You might as well have $1 million waiting for you at the end of it. Thank you so much for watching. I hope this video has inspired you and shown you that building serious wealth is within your reach. If you found this helpful, please hit that like button and subscribe for more content on personal finance and investing. Let me know in the comments below if you've just started your investment journey or what is holding you back. Let's start a conversation. Thanks again, and I'll see you in the next video.